and welcome to this very special edition of Taking Stock, the Fear Factor. You guys know why we've called it the Fear Factor. That's because of the immense capitulation that we saw in the markets last week. The Nifty was not down as much, about 2.5% or so, but the mid-caps were down 6% and the small caps were down 10% last week. So here we are at the Taj Lands End. We are attending the 6th India Investment Conference where more than 500 registrations have taken place, and we're going to speak to two very special gentlemen in a bit as well. Anuj is with me as well. Anuj, a week to forget?
Yeah, a week to forget, Sonia, but truth be told, warning signs were there. For last 3 or 4 days, we were pointing out that this is the market which is telling you that, get out of mid-caps and small caps. It's going to shut the exit doors. The market gave 3 or 4 exit opportunities all through the week, but on Friday that was taken out. On Friday, you saw the small cap index go down 6%. And so many index stocks are at 52-week lows now. The index was already in a bear market, let's make no mistake about that. And now you are running the risk of correcting the excesses in the mid-caps and small caps. But my sense is that what you saw in the mid-caps and small caps this week was actually a healthy process. Something we have seen in the past as well, that's going to make market healthy. But then, let's see. This is a bit of a falling knife kind of scenario, and global markets need to stabilize before we can say that the worst is truly over.
Oh yes, there was so much volatility in the global markets, but we have two gentlemen here who are joining us from this conference. We have NAVNEET, the Chief Investment Officer of SBI Mutual Funds, and JAYESH, the Senior Portfolio Manager at BIRLA Sun Life AMC. Gentlemen, thank you for joining us. Navneet, let me start off with you. When we entered here, you guys were telling us that no one wants to listen to us now with the markets have fallen so much. But you guys are the voices that everyone would want to listen to, because retail has invested so much money in this market. What would your advice be to retail investors now, post the fall?
So just the 18 months where people have invested, but before that we had 5 or 6 years of continuous redemptions in mutual funds. They also pulled out money from the unit-linked plans. There were hardly any IPOs. There was very little money that has gone into equities. So the overall money that has come into the equity market over the last 18 months looked big, but I think it's very small compared to the total household savings. And you have to see what's happening in the other asset classes. On a relative basis, I still think equities are one of the most attractive class to put money. People have very little allocation, and I think this kind of market is giving a good opportunity to enter from a longer term perspective. I just heard Anuj saying we are in a bear market. This is, I think, a bull market correction. I don't think that we can call it a bear market. This is not going to sustain for a long time, that markets will keep falling and we'll have several stocks touching 52-week low on a daily basis. And this is unlikely to sustain the way it has been today, or let's say the last week. Dark clouds are always followed by a shining sun. This time won't be any different.
Or this time it won't be any different. Have you seen any kind of anecdotal evidence of panic in the retail side in terms of some calls? Should I withdraw? Should I stop my SIPs? Or are you seeing a different kind of retail this time, which actually wants to take advantage of this fall and wants to buy and actually increase the allocation to equities?
I think in the last couple of months, couple of quarters, actually it has changed. When market falls, typically we get more subscriptions on that day. I think investors are maturing. They are taking a longer term call. Equities on a tax adjusted basis over a longer period likely to deliver far better returns than most of the other asset classes. And I think people are taking that, and there is a long term orientation in the money that is coming. We also hear SIP periods, which used to be 1 year, 2 year, 3 year. People are talking about 10, 15, 20 year SIPs, which wasn't the case till some time back.
Okay. Jayesh, what's the mood like? Are people worried about getting into a global recession worldwide, or is this just a passing phase?
No, I would believe that people are supportive of the market. People believe that equity markets in particular will give good returns over the long run. And there is a fair bit of understanding that this is a corrective phase. A couple of great themes that we heard today. One of the big ones was that the best money, the best returns is made when there is blood on the street. Wouldn't you call the last few weeks that kind of a situation? So any long-term investors would be looking at opportunities rather than being worried about what's happening in the market today. Talking about corrections and talking about mid-caps in particular, our sense is that mid-caps had not seen this kind of correction for a fair amount of time, although the large cap market was correcting. So in a way, all segments of the market have to show a correction for a healthy correction for the entire market to happen. And I think we have got into the second phase of the correction where the mid caps are also correcting. And I think from a medium term to long term point of view, this is very, very healthy. And what we are sensing from the investors are that investors are welcoming this. They would probably want to use this as an opportunity to invest more from a medium to long term point of view.
Okay, Jayesh, the clear trigger for this market fall was China. We saw the way yuan moved, there was some Chinese data, and all of a sudden all markets were scared, and there was this fear factor that we're talking about, and we saw the impact on the US markets as well. At some point we'll decouple, but for now, for how long do you think we'll have to endure this pain of these global cues?
Well, global cues are something that have made the market, especially in India, Indian equities fairly nervous in the last 2 months. And generally these phases don't last beyond a quarter or so. So I guess I would like to believe that we are at the tail end of the global uncertain environment. Let me correct you a bit. My sense is that more than the Chinese currency, it was the correction in the US equity markets which saw bigger corrections in other emerging markets, and India was no exception this time. And the reason probably is that US economy is probably one of the fastest growing in the world, and if that economy started, and that was one of the top performing equity markets last year, and that has started seeing correction, then probably it's kind of a contingent spreading across the world. But
Sure.
But remember, the top markets will always correct at the end. And so I again would like to believe that we are probably at the tail end of this correction. We may probably stagnate or consolidate for some period of time, but I would like to believe what Navneet said, that we are probably in a bull market with some short-term correction.
Okay. What about the large caps? I mean, good quality names are correcting like it's nobody's business. I mean, ICICI Bank, Axis Bank, TCS, Dr. Reddy's, all sitting at fresh lows. I take your point about some issues in the banking sector, etc. But is this a good time to be going out and buying into some of these large caps that are sitting at lows, or do you think that one can get better levels in, say, the next 3 to 6 months?
It's always very difficult to catch the bottom. I think if you like a stock, if you believe fundamentally it is good, it's falling for some other reason. I mean, there are two things. One is, for some of the names, there could be genuine issues that in terms of the balance sheet or in terms of the near-term profitability.
But that's the problem,
But if you
right?
genuinely believe some good name and you take a structural long-term call, I get reminded by this quote by Howard Marks: when the knife stops falling, when there is absolute clarity on the horizon, when the dust settles, you can be rest assured there won't be any bargain left. So I think there is discomfort today because you're worried about China, you're worried about what the US Fed is going to do, you're worried about the geopolitical risk, you're worried about then again this the asset quality issues with the banks. That's why you're getting these valuations in some of these names. But if you believe that franchise is strong over a longer period, things will get sorted out, the government is doing the right things, the economy has got potential, I think India will do well. Some of these companies will do well over a longer period.
But how do you find value? Because, okay, banks have asset quality issues, IT has slowdown issues, pharma has USFDA issues. So where do you really find value?
So, instead of looking at some of these stocks, probably put money in my fund and then and I think we will. So over the last year, on a very serious note, so over the last 1 year, where the market was down, where the index was down, I think several of the funds could deliver decent return. So when you look at the profit growth of the Sensex or Nifty or let's say BSE 100 and the profit growth of some of the fund portfolios, I think that will be substantially higher, because you just need to ensure that some of the companies which are dragging down the profitability are not in your portfolio. And I think this year, when you have this kind of indiscriminate selling, because of variety of factors, there are some redemptions from the EM funds and also here maybe the retail selling that Anuj rightly talked about. I think then you get some of these bargains which you can buy and then wait for a couple of quarters, couple of months, years to make money.
What if this is actually worse than 2008? For all you know, 2008 has become a benchmark, and a lot of people come and say that this is not as bad as 2008. I ask, what if it is worse than 2008?
So we could very well have a situation where for an extended longer period of time we would go through this consolidation phase. But at the end of the day, companies are on their own are doing things to change the trajectory of their own earnings, and that will ultimately start reflecting in stock prices. So I guess there were 2 or 3 key issues, but the fundamental issues with the equity markets probably in the last 12 months has been that the earnings growth has been very, very poor. Our sense is that next 12 months you will see a big change in that trajectory, both for the large cap indices as well as the mid cap indices, and you will see substantial improvement. And once that factors in, you will have the real fundamentals come into play. Some of these technical issues and short-term issues will get disappear. So earnings growth is what investors should focus on. That is the fundamental reason why stock price should be what it is.
And ignore the global news for the time.
And ignore, at least for the short term, ignore it. Because most of this may not really affect India in a negative way.
Well, as you heard, that's an optimistic lot that we're talking to, but we're not done with the questions just yet. Stay tuned, we'll come back in a bit.
The last 7-8 years, 8 years to be precise, from Jan 2008 till date, the index is up only 20%, the large cap index, and the nominal GDP would have grown more than 120% over this period. So I think definitely the market cap to GDP of India is in a very attractive zone. And therefore, I think the outlook for the markets over the next few years, to my mind, is very positive.
The fact that a number of large cap sectors have become uninvestable, but large investors in US, and when they come in, they want to own names for 4-5 years. And in fact, these guys, I'll tell you, they are much more, they are very happy to look at names, even smaller names, where management quality is good, earning visibility is higher, and the capital efficiencies are good.
I think the structural flow story from domestic institutions is still in place in India. This is a story about less competition from fixed deposit rates, and over a medium-term view, you've had a reasonable compounded return from Indian equities. What you've always got to remember with flow stories is, as a fund manager, if I'm nervous, I can choose not to invest that money that's coming in and wait for a better price. I think you could retest those lows if this uncomfortable story in China was to play out.
The guys who are not there in SIP, if there is one time to start, it is now. Because in down market only you must start, and in down market you must not stop. Very purpose you did the SIP in the good market. Looking back, I'm saying at 9,000 you started SIP. You did that because you were not comfortable with 9,000. You thought that market might come down to 7,000. But now when market has come down to 7,000, you should not stop it. On 1 year basis, I'll be very surprised your market is 10% down from here. Very unlikely. See, it's all probabilistic. In the market, it's all about the probability. If you ask me, I will give 70% probability, 75% probability that market will be higher from here, a year henceforth. But there is a 20-25% probability that market could be 5 to 10% lower.
We are very differently positioned today than we were in 2008. In 2008, all markets were at all-time highs pretty much. If you use market cap to GDP ratio as an indicator of overvaluation, most markets were in the 140-150% range of market cap to GDP in 2007-8. But over the last 7-8 years, there's been massive divergence. I think the sort of effects that some sort of global correction would differ from market to market.